We recently published our Singapore credit outlook for the first half of 2024, where we shared our key themes for investors in the Sing dollar credit market, including 1. The Sing dollar credit market remaining resilient despite challenging 2023 conditions, although overall issuance volumes fell to a 5-year low. Number 2. A buy while rates are still high approach for 2024, as credit as an asset class can act as insurance against a global growth slowdown. Number 3. While value may be scarce due to the demand for Sing dollar denominated papers in 2023, that any potential drop in rates and widening of credit spreads may uncover opportunities for investors, as we no longer have an underweight position on any sectors within the Sing dollar credit market. First, some context from 2023, which was challenging amid sticky inflation, escalating geopolitical risks, and rising US interest rates. As much as 2022 was also a tough year, 2023 was even more so, as known unknowns became unknown unknowns. What does this mean? Well, markets expected a slowdown in rate hikes and a peak in interest rates sometime in 2023. And while in hindsight this happened with the US federal funds rates peaking in late July 2023 and remaining on pause since then, it was not a smooth sailing pause, as the US economy continued to signal signs of strength at certain periods instead of the expected economic slowdown. Trying to curb the rise in prices due to sticky inflation became an arduous and painstaking process, and this translated in 2-year and 10-year yields reaching 16 and 17-year highs respectively in October, per Bloomberg. That said, the highs in US Treasury yields in October were brief, with lower inflation numbers, commentaries by companies indicating some pockets of consumer weakness, and a dovish FOMC policy pivot in the last 2 months of 2023, leading to a plunge in US Treasury yields. This injected market optimism that the prospects of rate cuts were near and suggested that the higher for longer rates narrative is closer to coming to an end. Stable or lower rates in 2024 could improve risk sentiment and benefit risk assets. As a result, there is a good chance that credit markets could offer decent returns to bondholders in 2024. As for Sing dollar credit markets, returns rebounded in 2023 amidst lower rates, but bond issuances fell to a 5-year low from peaking interest rates, unexpected economic data, Federal Reserve uncertainty, and geopolitical tensions. Government-linked issuances were affected by the inactivity of the Housing Development Board, but this was partially offset by issuance from financial institutions driven by their resilient fundamentals and strong balance sheets. Sing dollar credit markets gained 7.6% in 2023, which more than clawed back its losses of 6.8% in 2022. Investors benefited when interest rates tumbled from its peak, in line with increasing expectations of Fed fund rate cuts in 2024, with the underperformer in 2022, long-dated issuance, transforming into a market darling in 2023. Other buckets also performed well, including mid-tenor papers, Tier 2 bank capital instruments, and other non-perpetual subordinated papers and non-financial perpetuals. Despite the total write-down of the Credit Suisse Group AG additional Tier 1 bank capital instruments that represented around 7% of the Sing dollar AT1 market, total returns for AT1s were positive. So what does 2024 have in store? Our theme for the first half of 2024 is to buy while rates are still high. It is somewhat aligned with our second half of 2023 Singapore credit outlook, but with some adjustments. Number 1, we seek to position in the belly and long tenors when opportunities arise. In particular, we believe issuers may look to lengthen their maturities in the first half of 2024. While we think any fall in longer end rates from here are likelier to be capped versus the shorter end, our preference for belly and long tenors versus shorter dated tenors is also driven by rising reinvestment risk. Number 2, it is still too early to allocate higher portions into real high yield or distressed credits in the first half of 2024, even with potentially somewhat improved funding environments. While lower rates and lower recession risks in 2024 are expected to support risk sentiment and risk assets, we remain cautious due to ongoing global uncertainties. There are select opportunities in crossover credits, but investors should continue to focus on bottom-up analysis. Number 3, We maintain a neutral stance on corporate perpetuals and urge caution regarding non-call and reinvestment risks. Falling rate environments pose a double-edged sword for corporate perpetuals, as the new reset coupon rate may not be high enough to incentivize issuers to call them. Even if these perpetuals are reset at a high coupon rate, perpetual holders may also need to take into consideration high reinvestment and call risks amidst falling rates environment, as the issuers normally have the option to call back the perpetual every 6 months after the first call date. Perpetual holders may get back the capital during low rate environments and realize there are no longer attractive yields available to invest by then. In general, the option value increases for issuers in a falling rate environment. Number 4, in contrast, bank capital instruments such as additional Tier 1 and Tier 2 securities could be more attractive in a falling rate environment. Banks tend to call back these instruments on the first call date, and they offer structurally higher returns from high quality and regulated issuers. Again, however, careful consideration of structure and bottom-up selection is crucial given rising credit dispersion in the financial institution sector. We no longer have an underweight position on any sectors within the Sing dollar credit market. Credit showed resilience as an asset class in 2023, and we think it can act as insurance against a global growth slowdown in 2024. While value may be scarce due to the demand for Sing dollar denominated papers in 2023, any potential drop in rates and widening of credit spreads may uncover opportunities for investors. Thank you for watching, and we look forward to updating you more in 2024.